Hey guys, what's up? I'm Erin and welcome back to the channel. How much can you plan on taking out of your investment portfolio every single year without the fear of running out of money? I'm not going to say 4%. Yes, it's simple, it's a clean rule that we all know, but we all know that it's kind of flawed. It's built on one very specific situation of retiring at 65 and having a traditional retirement that lasts, say, 30 years. That's not most people anymore. People are living longer, some are retiring at 55, others at 70. Your timeline changes everything. A 40-year retirement time horizon is totally different than a 20-year retirement time horizon, and your safe rate of withdrawal shifts based on the timeline you need your money to last and the income target you want to hit. So let's dive in and see how it changes. Let's start with the basics, the 4% rule. This comes from a very well-known study that says that a retiree can withdraw 4% of their total investment portfolio in their first year of retirement and then adjust that number upward for inflation every single year. And if they do that and follow that withdrawal strategy, their money can safely last for 30 years. But there's a catch. This study assumed that there was a 30-year retirement. It assumed the historical returns of our stock market and bond market. It assumed a very steady rate of spending that did not change. And importantly, it assumes that you retire around the age of 65. But what if you retire earlier than that or later than that? Well, then we see that the 4% figure starts to break down a bit. When you retire early, say at 55 or even 50, your portfolio has to stretch a lot longer. You could easily be looking at 40 years of withdrawals, and at that point, you're exposing yourself to a lot more potential market downturns, inflation risk, and just potential uncertainty. On the flip side, if you retire later, your money doesn't need to last as long. There's less risk, so you can ramp up this withdrawal rate. That's why your age at retirement directly impacts what a safe withdrawal rate looks like for you. And that's exactly what we're going to explore next. Here's where it gets real. Let's break this down by retirement length, whether you're planning it for 10 years or 40 years. I'll show you exactly how much you'd need saved to safely generate $40,000 as an annual income from your portfolio. If you're retiring at 55, you're looking at a long journey, potentially 40 years of withdrawals. Now, safe withdrawal rates estimates for this timeline typically range from 3 to 3.6%. At a 3% withdrawal rate, you would need about $1.33 million. At a more aggressive rate of, say, 3.6%, that amount drops to around $1.1 million. But here's the nuance that a lot of people miss. This assumes that you are spending the same exact amount every single year throughout the course of your entire retirement. The only adjustment you're making is an increase for inflation on an annual basis. But this really isn't what we see when we look at retirees' actual spending, especially when we look at early retirees. Also, at the age of 55, you likely don't have Social Security yet, and likely you're paying out of pocket for healthcare costs because Medicare isn't there yet. So for those first 10 to 12 years, there's really a heavy burden on your investment portfolio. So let's break down this portfolio into two phases. For the first 12 years, you're covering the full $40,000 a year in income from your investments. That's $40,000 times 12, so you'd need a minimum of $480,000. But to be safe and add a little bit of a cushion against volatility or just unexpected expenses that may come up, I would say you'd want to put anywhere from $500,000 to $600,000 aside for this phase. Now, yes, this money is going to be invested somewhere where it's earning a modest return. Maybe that's T-bills, CDs, a money market fund, something like that. Maybe you even have a small amount that is in equities, maybe dividend-paying stocks, so they don't fluctuate as much. But the whole point is that you want this money there and accessible when you need it. You don't want to expose it to a 100% equity portion of the portfolio because that would be too much volatility at this time. And that's really important because this is the most fragile part of your retirement. This is where you're drawing the most heavily from your portfolio and also where sequence of returns risk is highest because your portfolio is brand new. Now in phase 2, Social Security kicks in, and let's say that's around $24,000 a year. If you still want to spend $40,000 annually, your portfolio only needs to cover the remaining $16,000. Using a 4.5% withdrawal rate for a 28-year period, you'd need about $355,000 for this section of your portfolio. So if we put both of these phases together, needing around $500,000 to $600,000 for your early phase, plus $350,000 to $400,000 for that later phase, that would bring us to a total portfolio of roughly $900,000 to $1 million. So yes, if you're planning on using that more aggressive rate of withdrawal, that 3.6%, you could potentially retire early with a $1.1 million portfolio. But at this time, you really want the markets to be kind to you because you're inherently introducing more risk to your portfolio. If you want to retire in a safer manner, I would suggest adding a buffer and maybe retiring with a $1.2 or a $1.3 million portfolio. And really taking the time to look at it at least from a two-phased approach, maybe even breaking it down further into more phases. And I have videos that do that in greater detail that I can link above and down below. Okay, so that was the early retirement path scenario. But what if you're planning a more traditional retirement, the 30-year retirement? Well, this is what the 4% rule was built for. Here, the withdrawal range estimate goes from 3.7 all the way up to 4.8%. With a 4% withdrawal, you'd need a $1 million portfolio. At a 4.8%, you could get by with around $833,000 in investments. Most people with this retirement time horizon have Social Security that's already kicked in at this point, and perhaps they're even eligible for Medicare, so that alleviates a lot of those healthcare costs. So having Social Security and Medicare really takes the burden off your portfolio and alleviates the pressure on your investments. Now let's fast forward a bit. What if you want a delayed retirement? Maybe you enjoy the job you have, so maybe you don't consider retiring until, say, the age of 70. Well, with a delayed retirement, you have less of a retirement time horizon to fund, and you can handle more risk. You can handle a higher withdrawal rate because your portfolio does not need to last as long. At this point, your withdrawal range could be 4.5 to 6%. At a 4.5% rate of withdrawal, you would need about $889,000 in investments. At a 6% rate of withdrawal, you'd need a portfolio of just $667,000. Here again, Social Security is an active income stream, and our individual is likely eligible for Medicare, which helps to control those healthcare costs. So again, this really allows you to have more flexibility with your portfolio and alleviate a lot of the pressure that you would otherwise need to put on your investments if you were withdrawing 100% of your income from your investments. And finally, let's consider a 10-year retirement time horizon. Now, there could be multiple reasons for this. This might be a very late retirement, or maybe it's just a bridge strategy to get to a point where you have more fixed income streams, or you have lesser fixed costs that are fully covered by Social Security. So maybe you have Social Security kicking in, or an annuity is kicking in. So you have a lot of different options. You just need to fund 10 years. Well, at this point, you can afford to be more aggressive. And at this point, it's not really a retirement funding strategy, more as a drawdown strategy. Here, the recommended withdrawal ranges could be anywhere from 6 to 7.5%. With a 6% rate of withdrawal, you would need close to $667,000 in investments for a $40,000 annual income. At a 7.5% rate of withdrawal, you'd only need a little bit over $500,000 in investments. With such a short time horizon, you really just want a known pool of money to draw on. You can be more aggressive with your withdrawals, but you really don't want to expose it to a great deal of volatility. You want to know that that money is there when you need it. Here's where things can go sideways. Use a withdrawal rate that is too high for your situation, and you could run the risk of running out of money. Especially if you're an early retiree or you hit a really bad market in those early years, you can run the risk of fully depleting your portfolio. But what if you go too low and you underspend in retirement? Well, this is a different kind of loss, and this is a different kind of risk. You work your entire life to build up this savings to fund your dream retirement. But if you're so fearful of touching your savings that you underspend and you don't fully enjoy your retirement, well, that's a problem too. This is really why it isn't about chasing some magic withdrawal rate. It's about choosing the withdrawal rate that fits perfectly with your strategy, your timeline, your income needs, and especially your safety. There are a few more factors that play into what's safe and what's not. Market returns, especially in the early years, and this is known as sequence of returns risk, and it can really impact early retirees. Inflation is a big concern, especially when it comes to healthcare, where costs for healthcare routinely outpace inflation on an annual basis. When you claim Social Security matters. Do you want to claim early? Do you want to claim at full retirement age? Or are you doing delayed claiming? When you decide to claim is going to have a major impact on how much you need in your investments. Your personal investment mix. If you have a portfolio that is too conservative or too aggressive, you can really throw off your portfolio long term and hurt the longevity of your portfolio. And finally, your flexibility. If you can adjust your spending in the tough years and not withdraw from your portfolio during those times, you can afford to have a much higher withdrawal rate over time. So what's the right withdrawal rate for you? It starts with how long you expect your retirement to last. Are you retiring early and looking at funding, say, 35 or 40 years in retirement? Or are you doing a delayed retirement closer to 70 or even 75? Well, here's a simple 3-step plan to consider. Number 1, estimate your retirement duration. Number 2, choose a withdrawal rate that fits your timeline and your comfort level. And number 3, work backwards to your savings target using your income goal. For example, if you want $40,000 a year as an income from your investments and you're planning a traditional retirement of 30 years, maybe you want to go with the 4% rule and you want to have $1 million nest egg when you step away from the workforce. However, if you're retiring early, you want to build in a conservative buffer. You might want to adjust that number upwards and that withdrawal rate down. And remember, it isn't about a set it and forget it number. Your safe withdrawal rate can and probably should adjust over time. As your spending changes, Social Security kicks in, or the market shifts, so too should your drawdown strategy. Retirement planning isn't about hitting some mythical number. It's about building a strategy that fits your plan and lasts as long as you do. The key is to think in terms of your timeline, your income needs, and your flexibility. Don't just pull a number from a headline you saw in a news article. What do you think is your personal ideal withdrawal rate? Share your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Every single... Can't mess up on the first sentence. I want to watch the rest of the video. This is going to be a rough 4 months. I'm going to live here for 4 months. The number of trucks that are beeping, dogs barking, school activities. This is just so much. I hate it. I hate it so much. Access it. Do you do 3 like this, or do you do 3 like this? I feel like in life, I do 3 like this, and then when it's YouTube, I do 3 like this. I don't know why, but leave me your thoughts. I'm curious.